So essentially what this is designed to do is encourage low and middle income earners to contribute more money to their superannuation, and then the government will put in money to basically encourage them not only to put in money themselves, but the government also helps by contributing to be able to boost up their balance. So there's
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are. We are back on another episode of the podcast, and I can't believe that we're talking once again about end of financial year and tax planning tips. The year goes so quickly.
It's scary how quickly it does come around, and it's one of those things that I'm sure if we look back on the previous episodes of the podcast, we'd say exactly the same thing, because we say it each and every time, and it's like it's just one of those things. But here we are, talking to our listeners and our viewers, and hopefully get some ideas out there for people to consider of the things that could take advantage of at this time of year before tax time. And let's rip into it.
Yeah, absolutely. So, Bills, first thing, end of financial year is approaching. What's first off the cab rank when you're talking about end of financial year and some planning that you can put towards that?
I mean, look, we're always a little bit biased because this is kind of like our bread and butter, but we always tend to pivot towards super. So we might start with superannuation and just some of the things that you can consider and you can do there, because
So powerful.
that's the thing. It is such a powerful vehicle. So the first thing is in terms of how much money you can get into super. So taking advantage of what that looks like from both a concessional contribution perspective and also from a non-concessional contribution perspective. So essentially, how much can you put in pre-tax and how much can you put in after tax? Each and every year, there's caps on that. $27,500 pre-tax, although I'm sure we'll jump into the carry forward or the catch-up contributions, I should say. And then there's the after-tax $110,000. So if you've got the cash, if that's a strategy that you want to deploy, looking at that before the 1st of July, because you don't want to miss that window if it's available to you.
Yeah, absolutely. And I love superannuation contributions when you're talking about tax planning, because you're effectively taking money from your own pocket and giving it to your future self and getting a tax deduction on it. I mean, when you consider what normally happens with a tax deduction is you take your money, you give it to somebody else, and you get a tax benefit as a result of it, whereas you're just giving it to your future self. So the money's not lost, it's just delayed gratification, and you get a immediate tax benefit as a result of it too.
It's just tucked away until a later date.
Exactly right. And look, this is something that a lot of our self-employed clients will look at. I mean, yes, your salary employees, you're getting your normal superannuation contributions. You're considering, do you put in some pre-tax money into superannuation in order to reduce your tax burden? But your self-employed clients, you're usually doing some work with your accountant. So you're looking at, what's the income going to be this financial year? Do I have any capital gains that I need to, bring down my taxable income as a result of? And do I just put in a lump sum into superannuation in order to alleviate some of the tax burden? So if you're going to start doing that, you definitely want to be doing it sooner rather than later and plan for it as much as you can. A lot of the times we get calls on the 29th of June and you're scrambling on the last couple of days to get the money in because, the superannuation trustee needs to approve it. They need time. You're pulling in favours and it's a bit of a disaster. So the sooner that you can do it, the better off that you're going to be.
Yeah, bring that deadline back by about 10 days. So not the 30th of June, maybe the 20th of June, because that gives the trustees time to allocate the funds. But one of the other really big things as well too is the catch-up contribution. So essentially what that is, we've spoken about it on the podcast before, but essentially what it is if you haven't maximised over a rolling 5-year period looking back, if you haven't maximised your concessional contribution cap, you can go back and basically use those and it applies it to the oldest year first. But as we tick over the new financial year, that fifth year drops off.
Yeah, so this is the first year that the fifth year will actually drop off because it only started from the 18-19 financial year.
Correct.
So this is the first time where if you don't use it, you lose it.
Yeah, exactly right. So one of the things is taking advantage of that, because if you've got a contribution available from the 18-19 year, you want to be able to take advantage of that before you lose it, right? And then that's a consideration, I guess, each and every year, because you're approaching it, it's going to drop off and away you go. So that's definitely a really good one. And we're having, significant discussions with people around contribution strategies, just because it is too big, in my opinion, it's too big of an opportunity to at least not give some attention to.
Yeah, absolutely. And while you're on it as well, I mean, you spoke a little bit about after-tax or non-concessional contributions into superannuation as well. So they work in a little bit of a different manner. So your pre-tax contributions, you look backwards. Your after-tax contributions, you look forwards. And so they love to just make things as complicated as possible for people. Don't ask me why they do that. But
well, that's good news for us, right?
Yeah, exactly right. But your after-tax contributions, you look forwards 3 years. And so what you've got the opportunity to do at this point in time is, we're recording this sort of mid-May. You've got the opportunity to put in an after-tax contribution in this financial year.
Yep.
Not utilize your bring forward contribution in your next financial year. So you can put in 110,000 this financial year, and then in 2 months' time, utilize your bring forward contributions, which we've actually got scheduled in to talk about the changes. But you can put $360,000 as a non-concessional bring forward contribution. So you can pump in $470,000 over the space of really a couple of months.
Yep.
Really good way to do it. As you're approaching retirement, pump in a significant sum of money into superannuation and have it in a tax-free environment.
Yeah, I mean, that's when superannuation starts to get, not necessarily, not getting exciting, but you're starting to talk with some fairly significant amounts of money. And, just coming back, a bit of a refresher, the more money you can get in, and there's certain caps and things like that, but generally speaking, the more money that you can get in, the better off your tax-free income will be when you reach preservation age and when you start drawing on that retirement income. So
it's a very interesting conundrum. Most people, super, whatever. No one really wants to talk about it. It's not exciting. Can't access it. Who cares? It's all good. And then you get to, someone who's in their mid-50s and it's like, how can I put more in? Because you're, only a few years away from having all of this money. I mean, up to, what's now been tabled, $3 million or $1.9 million in your, transfer balance cap. But you're talking about $1.9 million that's completely tax-free in earnings, completely tax-free in capital gains. It's absolutely massive. And so most people are, trying to pump in as much as they can, but you're limited to what you can do versus start some planning early and the implications can be significantly better.
It's always the challenge around allocating the money, Andrew. We tend to see that when clients are younger, maybe it's servicing the debt and getting the mortgage down. And then as you get older, you've got that under control. Maybe you then start to pivot with your superannuation. But just part of the fun of the things that we deal with in our world, which is great. But let's keep moving. So the government co-contribution. Yep. So essentially what this is designed to do is encourage low and middle income earners to contribute more money to their superannuation. And then the government will put in money to basically encourage them not only to put in money themselves, but the government also helps by contributing to be able to boost up their balance. So there's a couple of numbers and a couple of thresholds here. So if you earn over $57,016, you're not eligible, right? Anything lower than that, and the number then goes to $42,016. So if you're lower than $42,016, you get the full benefit, and between 42 and 57, it shades out depending on what it is. So for every there's $1,000 contribution amount that you can make, the government will match it at 50 cents. Yep. So you will get as a maximum benefit from the government $500. Yep. So that's not bad considering you put $1,000 in of your own money, and then the government gives you another $500.
Yeah, I mean, you're talking about a 50% rate of return.
Not bad.
I don't know too many investments that are going to give you that guaranteed rate of return. So, I mean, if you're doing that each and every single year, it can be, very beneficial. But you need to, have the discipline around it. The other thing to note is that will happen automatically. You don't need to claim it. You don't need to do anything. That will actually just happen as part of
when you do your tax return. Yep. It all gets linked through your tax file number.
Yep. Another one, which again, you're talking about, some of the other smaller things you can do to help boost it up is your spouse contributions. Now, in order to be able to take advantage of it, you can get a maximum tax offset of $540 by making some spouse contributions. Your spouse does need to be earning less than $40,000 a year to get any benefit. And in addition to that, it gets shaded. So if your spouse is earning $37,000 a year, you get the full benefit. $40,000 a year, you get no benefit. And you can get a maximum tax offset of $540 by putting $3,000 to his or her superannuation fund. So another way to, get a bit of a tax benefit, help boost the partner's superannuation. So if someone's on maternity leave or someone's taking time off work or someone's just earning less money, there's an ability to, help boost up their super and claim the tax benefit as well.
Yep. So superannuation is always a really good one.
Yeah.
End of year tax planning, that's probably the go-to in terms of our mind that we think about first and foremost. Andrew, outside of the superannuation system, I think deductible interest is always a really big one as well too. So if you can prepay any interest that you're going to incur on something that's deductible, you can bring that forward. You can claim that in this financial year as opposed to it happening next financial year.
Yeah. So a big one is margin loans. I mean, if you're, looking at things and saying, hey, I've got a margin loan, they'll give you the ability to prepay the interest for the next 12 months. I mean, if your income's going to be the same, it doesn't overly make a huge difference because whether you get the tax benefit this year or next year kind of is going to equal itself out. I know time value of money, having money in your offset account and all of that stuff is going to be beneficial. But really the benefit is if you're talking about, having a significant capital gain or you got a large bonus, your income is higher in this financial year, you want to bring as many of your expenses in the year where your income is the highest. Yeah, it's ultimately what you're trying to do there.
Yep. And I guess a continuation of that is if we think about a significant, say, capital gains tax event.
Yeah.
So, I think the one that's probably easiest to resonate with is maybe selling an investment property. So you're selling an investment property. Once again, this takes some planning in order to do this. So it's not necessarily an end-of-year tax strategy, but it can be. But trying to time the sale, especially if you're sitting on a significant capital gain in a particular income year when your income is less or you've got a lot of expenses to be able to claim against that because, it just means paying less tax right across the board.
Absolutely. I mean, sometimes it's easier said than done. If you can plan it and whatnot, that would be fantastic. Sometimes not.
Yep.
And if you're a salaried employee, you're not going to take a year off work to be able to
just to pay less tax, right? Yeah.
But if you're self-employed, if you've got the ability to delay income and bring forward expenses and do all of that stuff, then absolutely can be hugely beneficial. One of the other things that it kind of baffles me to some degree, and I'm all for it to a certain extent, is looking at, deductible expenses and where you can, spend money before tax time to claim a tax deduction. Now, the thing that I really want to stress in this is you're not spending money to get a little bit back on tax on things that you don't need or on things that you otherwise wouldn't have purchased because that makes absolutely no sense.
Yep.
I mean, if you are going to be purchasing, new equipment anyway, and you can do it just before tax time and get the benefit now and this year rather than waiting until your tax return in, the next year, then fantastic. All for it because you're going to incur that expense.
Yeah. Only if you're going to buy that, right? You're not going to make a purchasing decision just from a taxation perspective,
which often happens. I mean, I'm amazed by how frequently people will spend money so that they can get a tax deduction. And I don't understand it. It's why would you spend $100 to get maybe 37 of those dollars back versus not spend $100 and still have $100. I mean, you might, pay a little bit more tax as a result of it, but you're far better off not spending $100 and having $67 or $63 that's left over versus spending the $100. So you're at negative $100, getting $37 back. So you're at negative 63. I mean, there's still a $100 difference on both sides. So
to simplify that, basically, don't spend the money unless you need to for the purpose of the tax deduction. So if we think about someone like, say, Officeworks, who run all of those campaigns, the end of year stuff, they're probably not going to be a sponsor now that we've finally said that, right? But basically, no, it makes absolute sense. Like, if you're not going to incur that cost, I think the angle with that is probably for businesses. So something like our business, where you might be using consumables, and you need to upgrade a piece of equipment, as an example, laptops, microphones, camera, whatever it may be, although these look pretty good. But if you're going to incur that cost at some particular point in time, then maybe you bring it forward. But once again, it's the toss-up between spending that money now for the tax deduction versus... So it's not only the tax consideration is my point, it's also the cash that you're spending as well too.
Yeah, absolutely. Yeah. And the amount of times I see it where, the money's spent on credit and, you don't have the money to do it, but you're thinking you need a tax return so you can pay off the credit. It's nonsense.
Might have to talk to our accountant mates about that one.
Yeah, exactly right.
Yep.
It's like telling your boss, like, hey, pay me less. So instead of paying me $80,000 a year, pay me 60 because I'm going to pay less tax as a result of it.
There you go.
That's the same scenario.
I like your thinking, Andrew. Done. Done. All right, let's change course. Working from home expenses.
Yes.
I mean, that's a much, much bigger thing now than I guess it was previously in the past. So claiming working from home expenses, they can start to add up, which is good.
Yeah.
Normally you'd be talking to your accountant about sort of the work that you do, how many days from work, what does that look like? And they'll help with the calculation of what that looks like. But there's a whole range of different stuff.
Yeah.
Electricity, internet, for using your mobile phone for, work uses as well too.
Yeah. And there's a few different methods of calculation. So, not going to step on any accountant's toes or anything like that, but there's a few ways that you can calculate working from home. There's a simple method. There's, having your receipts. The thing that I always will always say is have your receipts, have it there and allow the accountant to make the decision around which method's going to be most beneficial for you.
Yep.
So make sure that you're just recording all of those expenses and keeping those receipts when you actually need it.
Mm-hmm. Yep. No, definitely makes sense. I think a real practical one is, we get excited about this, but reviewing your budget. And more so, I think from my end, it's like when you hear about New Year's resolutions, right? Like it's always at the start of the new year, reviewing your budget, new financial year.
Yeah.
What does the next 12 months look like? So getting that plan in place and basically saying, yep, this is what it's going to look like. And I think it's a great time to be able to look at your budget.
Yeah, absolutely. I mean, look, I'm a huge fan of reviewing your budget at end of financial year rather than end of calendar year.
Yep.
Just because calendar year, like there's so much going on. There's Christmas, there's New Year, there's summer weather here in Australia. Like you're out, you're doing things, you're on holidays. Whereas when you're reviewing your budget at the end of financial year, it's usually cold, it's usually rainy, usually not a whole lot going on. And so you probably have a little bit more time to be able to, sit down and actually pay some attention to it. And you're probably more likely to do it at this time.
So that's the thing that warms Andrew up. Is that right? Doing the numbers?
Yeah, no, I think it's just that you're, in, really gloomy, depressive, kind of mood that what's another thing to throw on?
Or is it that you set your budget so when you lead into Christmas, you're like, honey, here's the budget. It's already set. That's what it is. We can't. Yeah, that's it. That's it. We've done it. We made that decision 6 months ago. So no, I like your thinking. But yeah, real practical step. I think that's always a really good one and quite timely as well too, because cost of living is still a huge issue. People are struggling to make ends meet. So doing that and seeing if there's anything that you could optimize in that position, I think it's always a good hygiene thing to do. But especially around this time of year as well, I think it makes sense in terms of what you were saying, lighting that up with the financial year.
Yeah. Another thing that, is a plug to another podcast. So encourage you to go out and listen to the Debt Recycling podcast. it's probably the one podcast that we've gotten the most inquiries about because I think it's the thing that resonates very strongly with people. But when you're talking about tax planning, there's only certain things that you can do just before the end of financial year. I mean, it's like cramming for an exam, the night before. Yeah, there's some stuff that you might be able to,
I don't know, it worked for me back in the day.
There's some things that you can sink in, right at the very end, but ultimately the best result is going to be, having a proper strategy and having something where you're planning long in advance for. And a debt recycling strategy is just another means to be able to convert some of that owner-occupied debt that you might have to deductible debt. I'm not going to go into the details of it because it's a podcast in its own. But with some proper planning and having the proper, time frame to be able to execute, looking at strategies like that, not necessarily for this financial year, but for next financial year and all of the financial years thereafter is another really massive one as well.
No, it definitely makes sense. And I think, in a nutshell with all of this is doing the work early in conjunction with your accountant or your tax advisor definitely makes sense. I mean, we're huge advocates of getting advice, and people that play in this space are going to be able to deliver the best outcome and the best advice to you. So getting that going nice and early. So then if there's anything that you need to do or want to do, at least you've got time to be able to make that change. Right? You don't want to go and knock on their door in the middle of June and go, okay, how do I minimize my tax? Because you've probably missed out on, 11 and a half months of opportunity. Yeah.
Exactly right. Have the right people around you and make sure that you're getting advice is the big key takeaway.
Yeah, 100%. Andrew, what do you reckon? Short, sharp, punchy? Hopefully that gave our listeners and our viewers a whole heap of stuff to think about for end-of-year tax planning.
Yeah, absolutely. And as always, if you got some value out of that, like, subscribe. And if you want to get any more information or take into consideration your own personal circumstances, feel free to reach out to either Billy or myself, and look forward to catching you on the next podcast.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.